Good morning, everybody. This is the live market open for January 13th. It's Wednesday. It's the middle of the week. I'm Yohay Elam of Forex Crunch and Market Movers podcast, doing the show as usual for FX to read. So, as usual, as every morning, we'll cover recent developments. We had some changes, maybe temporary, charts and levels, the next 24 hours, and of course, your questions. Your questions are welcome in the chat. If you cannot see the chat box under the video, please go to tlk.io/fxstreet-forex-live-video, the address that appears on the screen. So, what did we have? The latest event, we had Chinese trade data beat expectations. These expectations were quite low. We still had a fall in imports and exports, but these falls were not as terrible as expected. And this means that with somewhat better imports, somewhat better exports, somewhat better activity within the world's second largest economy, and things aren't as terrible as expected, and we had some relief. Okay, this is somewhat different or more than different from what we had beforehand. Okay, so this is what we're seeing now. We're seeing a weakening of the safe haven euro, 108.18 towards the lower range. Support is at 108, resistance 108.80, further support 107.10. Okay, and the same goes for the Japanese yen safe haven. We're off the lows, we're above 118. 118.30 works quite nicely as resistance at the moment. 117.40 is support. And so we're in one high range in both in dollar yen, and euro dollar is weaker. So we have a more of risk on atmosphere, risk appetite, going for buying, selling the safe havens and going for more attractive currencies. Of course, when we talk about China, we talk about the Australian dollar. So we had it climb above 70. The 70 line isn't that strong. It's quite choppy. 70.65 is stronger resistance, support at 69.40. So with better Chinese data, we have a stronger Australian dollar. For Australia, China is the number one trade partner, and if it imports more commodities like iron and copper, it's good for Australia. Okay, so we're seeing some risk on atmosphere, positive atmosphere, buying Aussie dollars. Okay, also dollar CAD is off the highs, but it really reached new levels yesterday. We'll talk about that soon. So currently 142.32. 142 is some support. We already reached 143, almost 20. I can put a line there, but it's hard to know where. It's always the sky's the limit with dollar CAD. Anyway, these are the levels to watch out for. Yeah, but let's also for the New Zealand dollar, we're a bit higher in the range, still finding it hard to climb above 65.80. Sorry, not that far from this level, but anyway, 65 is support. The Kiwi is relatively stable. Not a lot of news this week. Lots more news next week. Okay, now let's talk about the pound. Pound, we had quite a crash yesterday. We fell under 144, a new low, the newest lowest level since 2010. Currently some kind of stabilization, 144.33, but the pound still looks somewhat vulnerable. Okay, it doesn't really manage to recover if you compare it to commodity currencies. So let's get back to the events yesterday. Regarding the pound, we had manufacturing data and industrial output all coming out worse than expected. Fall in manufacturing, month over month, year over year, all the figures came out terrible. Let's try to see the data that we had in the pound. Yeah, so we can I'll show you that. So I was happy to see that data. Like, here we go. So we have, maybe I'll just enlarge the font. Yeah, here we go. Industrial output month over month falling 0.7 instead of remaining flat. Industrial output year over year rose only 0.9. And manufacturing, a smaller component but also important, fell month over month and fell harder year over year. Bad news all around for the pound. I was glad to see that indicators have an impact, and we really saw that tumble down, that crash. After I'm talking in recent weeks about the mood in markets, risk on, risk off, mostly safe haven currencies enjoying some strength, and the rest, including the pound, suffering. This time it was more related to the figures actually released in the UK. Okay. Another thing we had yesterday is crude oil. WTI crude oil dip under 30. This is a very important psychological level. We're currently above these levels, actually seeing a rise this morning because we're back to risk on, risk appetite, better news from China. But yesterday we had a small dip. It was only very short-lived. It was only 29.92, but it still triggered lots of headlines and probably some kind of stop hunting because we're above these levels. Today we have a big test for oil. Actually, it's the main event for today. It's quite rare. I find myself saying that oil inventories is the main event for today, but that's how it works. The mood still has control, maybe not over the pound, but over many other currencies. So currently trying to climb back above 31. 32.30 is resistance in oil, but the 30 level is still in danger. Another headline we had yesterday is that the Nigerian oil minister said that an emergency meeting might be needed for between OPEC members to decide perhaps on production cuts, but this didn't fly. We didn't have confirmation. And also, it's important to remember regarding oil prices. OPEC is only 1/3 of the global production. OPEC is consists of countries like Iran and Saudi Arabia, the biggest producers, which are at loggerheads regarding various issues in the Gulf. Recently, there was quite some tension between these countries. The smaller producers like Venezuela just want other countries to cut, but they cannot afford themselves to lose any kind of income if they cut production. And if we want a real change in oil prices, in the supply at least, we would need other countries such as Russia, Norway, Canada, the United States to decide on cutting production. And having all these countries agree on something is quite hard. Anyway, this is still an issue. So eventually, oil prices low. If prices remain too low, we're going to have less supply. It's not going to happen by agreement, but because of market forces. And eventually, low oil prices also lift demand because gasoline is cheaper. But I'm not sure we have reached the bottom of the barrel so far. Okay. Question here. Globally, most companies don't have real growth, but fake illusions for the masses that feel okay. It's a global recession, as I see, and that's how to trade it long term. I'm glad you raised this point. Well, I don't fully agree with you, but yeah, lots of companies, at least in the United States, are using their cash to buy back their stocks. Okay, so this is not real growth. If you see stock prices rising for some companies, it's just these companies using their cash or sometimes lending money when money is very cheap to buy back stocks. So this is certainly fake growth. Some companies have real growth. They're selling real products. Okay, not all is fake. And regarding global recession, yeah, yesterday we had commentary from Albert Edwards of Société Générale, French bank, but this guy is British, based in London, if I'm not mistaken. He said he had this doom and gloom forecast that we're going into global recession, that oil prices are going to fall. Regarding oil prices, he joined Morgan Stanley, which talked about $20 per barrel. And regarding global recession, he also talked about all these buybacks. He talked about all that's wrong, and that we're facing similar conditions to what we've seen in 2008 with the Lehman Brothers. So he really talked about 2016 as being the year of another global financial crisis. Okay, 2016 will be the same as 2008, according to Albert Edwards. Of course, not all agree with him, and he's a known bear, but his words do have an impact on markets. Okay, especially when it's a growing crowd. Okay, he's a known bear, but he's not alone. All right, so we have more and more these doomsayers. Now, eventually, when everybody's short, when everybody's talking how terrible things are, perhaps that's the time to buy. Perhaps that's when we're closer to the bottom. Okay, but like with the ECB, including myself, when a month ago I talked about the situation. I mean, Draghi promised so much and usually over delivers, but everybody was expecting that. It was so crowded that eventually, when he delivered, but not enough, we had all these short positions liquidated, and we had Eurodollar shoot higher from 105.20 at the bottom to almost 110. So we're still not there yet. Still mixed opinions about what's going on with the global economy. Remember, the US economy is still growing. Fed is expected to raise rates once again in March. It's not certain, but things are relatively positive over there. The Eurozone is showing signs of growth, but with this deflation, and that's also something Albert Edwards talked about, with this deflation from emerging markets, things could get worse. Okay, let's see. What's the forecast for pound dollar? More bearish? Well, yeah, pound dollar. Many say it's extremely oversold, so I'm not sure it's. We did have this big fall and big bounce from here, okay, from yesterday's lows. So I'm not sure it's all bearish. A lot depends on tomorrow's decision by the Bank of England. Let's see if we have time for that today. Today we don't have any UK, or at least no important UK figures, but tomorrow we certainly have. No, nothing British on the agenda today. There's a question here. The Baltic Dry Index fell to the lowest in history. If Baltic Dry went back to the 30s, probably would be lower than that. Algos are unemotional unless the programmer was emotional when programming. Yeah, I remember that all those algorithms, they make mistakes, but that's because those that program them make mistakes, and we're all human and we make mistakes. Regarding the Baltic Dry Index, yeah, it's falling for a very long time. There were some rumors that no ships are moving in the Atlantic, and that's of course not serious. Global trade is still going on, perhaps at a lower level. In some areas, China is slowing down, but it's not all the Baltic Dry Index. A question here from Fabian. Can you tell us about the non-monetary policy ECB's meeting that's going on this moment? How to evaluate the outcome when there are no figures? What's the impact on Eurodollar? Well, no impact on Eurodollar. This non-monetary meeting, of course, there's always risk there. It can always result in some kind of decision, but we haven't seen any headlines coming out of these decisions for a very long time. It was extremely important during the summer because these non-monetary policy decisions, these closed-door meetings by the ECB, they decided on liquidity for Greece and things like that. But at the moment, unless we have a surprising, I mean, we should be aware of this event if you're trading Euro-Dollar. But I don't mention it because for a very long time we haven't seen anything coming out from there. I would add that sometimes we have unexpected interviews by ECB members talking about monetary policy, and they give interviews to newspapers or they talk to some journalists, and this comes at an unexpected time and moves markets more than a scheduled meeting. So in the past few months, it's been faded. It's not like during the Greek crisis. Yeah. Okay, let's continue. Good morning, Jax, as well. Good morning, everybody. Let's continue with more things we had yesterday. So we talked about the Chinese trade balance that sort of helps markets, beats the safe havens and helps risk currencies. But yesterday was different with crude oil dipping under 30. UK manufacturing continues weighing on the pound. Yesterday I was talking about this Paris conference, which we had the Fed's Fisher, ECB members, Kuroda from Japan, and even Mark Carney speaking, but nobody rocked the boat. I was actually watching part of it. It was quite boring. I hope you guys didn't watch it. There was nothing worth mentioning there. US jobs figures, employment data, it came out a bit better than expected. Yeah, 5.43, not totally unexpected because November saw big job gains in the United States. Also, yeah, on the other hand, optimism fell. These are all second-tier figures. For the UK, also less impact, but this independent GDP measure for the last 3 months, which actually covers the fourth quarter, showed a growth rate of 0.6 quarter over quarter, which is good news for the UK. But this figure used to have more impact in the past, and it's being ignored because manufacturing looks bad. Manufacturing looks bad everywhere. Okay. Today on the agenda we have Eurozone industrial output at 10 GMT, 11 here in the old continent. But that's after Germany and France already released their figures. As with other developed countries such as the United Kingdom yesterday, and we'll see on Friday from the United States. In the industry, companies that actually make stuff, manufacturing is on the ground. It's even in a recession in some places. Also in China, it's contracting. So expectations are weak. The hope is that, well, we all know that the services sector in all these countries is doing much better, and that's the positive side, okay? The big event for today is crude oil inventories, because that not only impacts the Canadian dollar, but also other currencies. It sets the mood. If we have a rise in inventories, where did that figure go? Here we go. Well, I think it's more important than this calendar says. Anyway, last week we had a drop. It's released every Wednesday. Last week we had a drop of 5 million barrels. That's the crude oil figure. That was supposed to help oil. But the distillates, we have lots of components here. It actually went up. So we have more refined oil and not enough crude oil. This time, in any case, we're expecting a rise. Watch out for this figure for the mood. More oil in markets means weaker Canadian dollar instantly, weaker commodity currencies, also indirectly weaker pound, and a stronger euro, a stronger yen. If we have a fall in inventories, that means a drawdown, that means more usage of oil, less oil in storage. It's of course shows that there is more demand, and weaker euro, weaker yen, stronger commodity currencies. Okay, so I didn't think we'll reach a moment when this is the main event for today, but that's how it goes. At 7 GMT, we have some figures from the United States. We have the Beige Book. It's a report by the Fed about, right here. Report by the Fed about the economy. Has some impact. We also have a speech from Charlie Evans of the Chicago Fed at 5:30 GMT, but he's a known dove, and he has less impact. He's not voting, if I'm not mistaken. Anyway, and for those of you trading the Aussie, which has climbed over 70 cents, and we have Australian jobs figures at midnight GMT. This should have an impact. So we have a pause from Chinese figures impacting the Australian dollar and some domestic data. In the last 2 months in Australia, we had superb figures. We had, for instance, a rise of 71,000 jobs last month. This time we're expecting a drop of 12.5, so expectations are low. The unemployment rate is at 5.8. It's expected to rise to 5.9. So these relatively low expectations for the Australian jobs market, for the labor market, I think if we have a small beat there, we could have maybe another advance of the Aussie. But remember, if we have another fall of the Chinese stock market, another devaluation of the yuan, which has been stable, it may overshadow the Australian numbers. Okay, so these are the events for today. Looking forward to your questions, and we'll talk soon about more charts. All right, So we talked about the Aussie, we talked about the Euro. During the show, we're seeing it sort of, well, grind down a bit lower, but the ranges are quite limited. Lots more excitement in the pound. Safe haven yen weakening. Dollar CAD, lots of excitement. I must say that since the positive jobs report in Canada on Friday, we've seen the Canadian dollar show just a bit of relative strength. I'm not saying it's strong. I'm just saying that with the collapse in oil prices, I had expected the Canadian dollar to fall a bit more. Don't get me wrong, it's quite weak, but yeah, at least now oil prices are stabilizing. The Canadian dollar is stronger. That means dollar CAD is off the highs. Yeah, talked about the QE. Dollar Swiss. Well, with a weaker euro, that means also a weaker franc. That means dollar Swiss is above parity once again. Remember, the Swiss National Bank is ready to intervene. Euro Swiss, sort of grinding to a relatively higher level. Ranges are extremely limited, extremely boring, less than 20 pips. Remember that the governor of the Swiss National Bank, Thomas Jordan, said that the franc could weaken, and that means that they could intervene. Euro pound, yesterday we had another attempt. Perhaps we have a double top here at maybe 75.50. Yesterday we had the collapse of the pound, so we had euro pound rising higher. Now with the better atmosphere in markets, we're seeing some relief. This cross is falling today. Sorry. And 75, it's currently battling this level. Real support only 74.10. Euro yen, the safe haven cross, hugging the 128 level at the moment. Support 127, resistance 128.75, I would say. Pound yen extended its falls yesterday, fell, and we're seeing also a double bottom right here. So we have interesting technical patterns with the Gepi, with the pound yen. The dragon has lots of nicknames. So we're seeing it at 169.20, some kind of support, maybe some better technical behavior from this cross. I know that many traders like the cross because it provides lots of pips and it has very interesting breakouts. This is very true at the moment, with the pound being the back in the risk camp with commodity currencies, and the yen working as a safe haven. Okay, so we covered lots of crosses. Just to show you perhaps another crosses we've talked about in the show. For instance, euro against the Aussie, also reflecting this sudden improvement in the mood. Euro Aussie is down almost 1%. Okay, because the mood is better. Chinese trade balance is more positive. No need for the safe haven euro. Everything's good for now. Okay, the same thing goes for CAD. Smaller effect, only 0.5% lower. Anyway, this is what's going on today. So it's a, I don't know, positive Wednesday if you wish. We had a turnaround Tuesday, maybe yesterday. And yeah, safe haven yen is now, euro is now ticking a bit higher, but not going anywhere fast. It's relatively pushed lower in the range. Question here, what do you expect from the Eurozone industrial production? What do you consider good, bad figures, and what impact on euro dollar? I think the impact on euro dollar will be limited because remember the Eurozone figure is released after German and French figures. Let's look at expectations. So month over month, we're expecting a drop of 0.3% after a rise of 0.6. Look at the chart here. It's quite ticks up and down around zero. It's not that important. Year over year perhaps provides a better look. So we did have some kind of improvement. This is the fall here in the financial crisis. Then we had a rise. Then we had the second recession in Europe. Currently, things are improving. If you look from 2014, 2013, we are seeing sort of numbers moving higher. I mentioned a few times in the 2016 outlook, for example, that I think we're at darkest before dawn in the Eurozone. We had a euro that is lower for longer. Yeah, and this is positive for exports, lifts inflation just a bit, credit conditions are looser, things are getting better just a bit in the Eurozone. Of course, if we have some kind of global recession, as the big bears warn us, it's bad for the Eurozone. But if we have the ECB, for instance, deciding to print more money, to cut interest rates, even though it's mostly oil related, we could have even more stimulus. Answering your question, the year-over-year figure is more important. If we have, we just look at the number, 1.3 is expected, previous 1.9. If we have another repeat of, let's say, 2%, 1.9, 1.8, that would be, or even higher, that would be, of course, positive. And if we have under 1%, sort of very mediocre year-over-year growth, that would be negative. But I think the impact would be quite minimal. These safe haven flows, or risk on, risk off, if you wish. If you see, you see sometimes the risk on, or sometimes risk appetite. This is, of course, negative for the euro. That means markets are looking for better assets, riskier ones. And if you see risk off or risk aversion, it's positive for the euro. These, in current markets, these have more impact than this specific figure from the Eurozone. Inflation figures have much more impact because that determines the policy of the ECB. Next week, we have the ECB decision, 8 days from now. Not expected to do anything, but the mood, if they hint about action in March or not, that should have a big impact on markets, okay? So this week in general, we don't have too many important figures, I would say, apart from, was actually surprised by the strong impact of the UK manufacturing production indicators, just, well, that added to the global gloom atmosphere. On Friday, we do have figures. Let's talk a bit about, as we wait more questions, if you have. Talk about more events. Let's recap. The weekend we had Chinese inflation figures. They were okay in the CPI, but bad in the PPI. Tuesday, industrial output from the UK, which was terrible, had a big impact, a negative impact on the pound. US jolts had minimal. Today we have Chinese trade balance lifted the mood in markets, certainly had a positive impact. That means positive for commodity currencies, negative for safe havens and oil inventories. During the night, the Australian jobs report, and then tomorrow we have the UK rate decision. The big question for the UK, after all the recent bad figures, not all of them were terrible, but the big question is, will we have 9 members voting against a policy change, or still 8 against and 1 voting for a rate hike? So apart from manufacturing production and industrial output that we had yesterday, we've also seen a downgrade of growth figures in the UK. We've also seen wages falling, not falling, but the annual pace of rises in UK wages dropped. It was 3%, it fell to 2.4%. We had the Chancellor of the Exchequer, George Osborne, talking about a cocktail of threats. We have the risk, the Brexit risk of in the EU referendum. It's unclear if David Cameron will hold it in the summer, in the autumn, or maybe only in 2017. It's more likely this year. In theory, the Bank of England should not have political considerations, but we know that everything is on the table, of course. Anyway, if we have 9 members, if we have Ian McCafferty changing his mind and voting for no change in policy, that could serve as another blow for the pound. We'll talk about that a bit more tomorrow. But in general, no changes expected in policy tomorrow, but we do expect the meeting minutes to have an impact, as always. And on Friday, we have more significant figures from the United States. Sorry, just a second. We have retail sales that will show us if Americans did some Christmas shopping. PPI to give us a first hint on inflation. Then industrial output, which is expected to be bad like all over the world. And consumer confidence to tell us a bit more about consumption intentions for for January. Question here about Catalonia. What do you expect from Catalonia independence movement in terms of the Spanish economy? Well, here in Spain we have a double political crisis. Two things. First of all, finally over the weekend, the various two Catalan parties, one of them composed of other parties, they decided finally to form a coalition to have a new president of the Generalitat, which is the Catalan government, the Catalan autonomous government. So we have the main party is called Junts pel Sí, which means Together for Yes, a coalition of left wing and right wing, both mainstream and some known politicians, artists talking about, Puigdemont is Carles Puigdemont is the new president of the Generalitat. The smaller party, the radical left coup party, didn't want another term in office for Artur Mas, the former president, which is too close to the very corrupt politicians. And eventually they decided on an agreement to have a new president. He used to be the mayor of Girona, which is a town north of Barcelona. A very pretty city. Anyway, we have a new government in Catalonia. We don't have new elections. This happened only 3 months after the elections here in Catalonia, and this makes things complicated for Spain, and this desire for Catalan independence. Why does it make things worse for Spain? Also in Spain, we had elections on December 20th. It's almost a month. We have a very, very hung parliament. No party won an absolute majority. And even if you take the four big parties, you would need either a grand coalition of the two biggest parties, or you would need other three parties, or anyway, it's very complicated. Options on the table are for politics in Spain, either a grand coalition, which has never happened, between the right-wing Partido Popular and left-wing PSOE, perhaps with the new sort of fresh right-wing party Ciudadanos, which didn't have such a great success, or we might have left-wing government like in Portugal of the socialists, PSOE, what they're called here, Podemos, which is like Syriza in Greece, if you wish, and perhaps other smaller parties. Or we could have new elections. For the Spanish economy, the Spanish economy is in theory growing nicely, but we know that part of this growth is just based on deflation. Currently, everything goes on as usual. Credit is loose. House prices have stabilized. Let's see. Life goes on. It does make things complicated for the Spanish economy, yes. What I think will eventually happen is that we'll have a smarter Spanish government regarding Catalonia. We will have some kind of a referendum here in Catalonia about independence, and the result will be, like in Scotland, a small majority against independence. And that could settle the question. If we have ongoing refusal from Spain to say no referendum, what most Catalans want, this could, of course, turn out worse. Currently, everything is moving very, very slowly in terms of Catalan politics. Remember that all this rebellion, if you wish, all this desire, everything is 100% non-violent. So, yeah. Okay. That was a long speech about Catalonia. Let's get back to Forex. Could you tell us more about the beige book released today? Is it relevant to Eurodollar and how to evaluate it? It's relevant more to the state of the Fed, to the dollar in general. It's what the different Fed offices, I think there are 9, how they see the US economy. And if they see more moderate or modest growth or things like that. In general, if they see slowdown in the economy, it could result in no rate hike. And if they continue seeing things as okay, it's positive. This is the implied probability of a rate hike in March. Remember, in January, we have no press conference and expectations are for more than 90% no rate hike. But for March, it's an open question. So let's refresh this. Maybe we have a change from yesterday. No, more of the same. Anyway, more impact on the dollar. In the current market mood, if they show a strong US economy, it could be better for the mood in general. That means weak for euro dollar, but this usually doesn't have a strong impact. I'm mentioning this event because it could have an impact, but it's not a first tier one. Okay. Another one question from Sinatra. I worked at the MWC's, the Mobile World Congress, in the last 5 years, and I'm very much interested. Thank you for your views. I share your view about the Spanish government needing to act smarter. Yeah, we have the Mobile World Congress in a month here. Last year there were almost 100,000 people, but at least where I live, we have seen lots of people in suits, but the metro functioned without any problems. So is there a mortgage market there? How is it here in Spain? Yeah, there's most mortgages are based on the Euribor. Euribor is extremely low. That means that it's much cheaper to get if you take a mortgage, and banks are willing to lend out mortgages much more than they were 2 years ago. Okay, and for those people that have a mortgage, they're just paying less every month. So this also helps with more money in the pockets of consumers, because Euribor is what banks trade with each other, but basically it's what it's also a reflection of the ECB's policy, and it fell from around 50 points to around 5 points, and that's of course positive. The beige book, answering your question, gives hints if the Fed will hike rates. Yeah, but small hints. The bigger hints come from indicators such as the NFP indicators. What the FOMC members say. So the beige book, I would say, is a minor one. It used to have more impact, I think, before the financial crisis, but now the Fed is more transparent, and they talk much more. So in theory, it's released before the Fed decision, around 2 weeks. We have the Fed decision on January 27th, and this is 2 weeks beforehand, and it's sort of what the members have in front of their eyes when they come to make the decision. But as I said, in January, no change is expected. Okay? That answers the question. Oops, sorry for that noise. More questions? Let's see if we have more movements in markets. Okay, we're seeing some stability. I think maybe it's time to get to the wrap up for today. If you don't have any more questions, one more question here. No, it's not a question. Just saying thank you. You're most welcome. Just take another look at oil. We've been talking about the Chinese stock market and oil prices more than ever in the past few weeks. Yeah. Okay, so it's time for the wrap up for today. This is a wrap up for the live market open for Wednesday, January 13th. After a few sour days, including yesterday, we had a positive change overnight. The positive mood came because of better than expected figures from China, trade balance, not the bottom line, but just better figures from imports and exports. Don't worry, these are still negative year over year, just less negative than expected. What does this mean? First and foremost, Australian dollar is higher, above 70 and settling there. Resistance 70.65, support, weak support at 70, stronger support 69.4, because Australia trades a lot with China. It also means some better fortunes for the Canadian dollar. Dollar CAD falling now, 142.16. Support is at 142, resistance at the levels we've seen yesterday at 143. It also helps the Kiwi dollar just a bit, reaching resistance at 65.80. Further resistance maybe 66, support 65. And it also has an impact on a negative impact on safe havens. So dollar yen is moving higher, 118.30, extending the levels. Currently, this is some kind of resistance. Further resistance at 119.20 and 120. Support 117. No, 118, I would say, and 117.40. Okay, and also better mood in markets is good. Bad for the euro. Euro and yen are safe haven. Currently at 108.20 at the low end of the narrow range. 108 is support, followed by 1710. On the top side, 108.80 and 109.50. Okay, these are the major pairs. Perhaps standing out from yesterday is the British pound. Standing out, I mean, from commodity currencies traded with them. It did manage to recover, but not a lot. Yesterday, it got a big blow from industrial output and manufacturing production in the United Kingdom. It just came out much worse than expected. So, and it sort of adds to the doom and gloom figures. Also, we had some doomsaying from Albert Edwards in London of Societe Generale, talking about a global recession like in 2008. It was that the pound is in general weaker. Yesterday also we had oil prices tumbling below $30 for the first time in 12 or 13 years. And this is a psychological level. Currently oil prices are above 31, just at 31. Above, that's WTI crude oil. Also Brent is recovering with this the news from China, the better than expected trade balance. But today we have another test for oil. Oil is the main figure on the agenda. Crude oil inventories at 3:30 GMT, as every week, but it's becoming more and more important. If we have a drawdown in oil, that could support oil prices, support commodity currencies, weaken further the euro and the yen. But if we have a rise in inventories, that means more oil sloshing around, we could have a stronger euro, stronger yen, and weaker commodity prices. In addition, we have really second-tier figures, Eurozone industrial output at 10 GMT, the US beige book ahead of the Fed decision at the end of January, and perhaps another important figure, but not really immediately anytime soon. During the night, we have the Australian jobs figures. They were really superb in the past few months, past couple of months, and this time they're expected to be a bit weaker. So for the Aussie, we have a pause from Chinese data and some limited focus on Australian domestic figures. Okay, all in all, markets continue trading in this risk-on, risk-off atmosphere. Most of the time it's risk-off, most of the time it's negative, most of the time it's doom and gloom. Less manufacturing in the world. China is slowing down. China is the main issue. Oil prices are low, less demand because of China and other countries, too much supply. And from time to time, we have, like today, better figures from China and a correction and a better situation. The mood could darken once again. I don't see how things, we would need more than just one positive figure from China for the mood to really improve for a big turnaround. Yeah, so I guess that's it. Tomorrow we have the Bank of England, and Friday US figures, and we could have the return of indicators, but today it's more the indicators that are relevant are related to the global atmosphere. Okay, so that's it for today. Thank you very much, everybody, for coming. Thank you very much for all your questions. I enjoyed answering them as usual. I wish everybody a safe and successful trading day today. Hope we don't have any crazy stuff like we had this time last year. It's just on Friday. It's the 1-year anniversary to the SN bomb. Maybe we'll have a special tribute to that. And yeah, currently things are a bit more stable, but let's see how things evolve. Anyway, I wish everybody good luck today, and see you all tomorrow. Thank you, and bye-bye.